Hello, good morning everyone. Please come to question number 6 now. Please come to question number 6. Valuation of share. May 2021 RTP question. May 2021 RTP question. Are you ready? So this is the question. ABC Limited just declared a dividend of rupees 28 per share. Mr. A, underline this 28 rupees, just declared means D0. Just declared means D0. Declared a dividend of rupees 28 per share. Mr. A is planning to purchase the share of ABC Limited, anticipating increase in growth rate from 8% to 9%. So what will be the growth rate henceforth? 9%. Growth rate will increase from 8% to 9%, which will continue for 3 years. So this 9% growth rate will continue for 3 years. He also expects the market price of the share to be 720 after 3 years. So this is P3. P3 720. P3 720. You are required to determine the maximum amount Mr. A should pay for the share if the discount rate is 13%. So you have to find intrinsic value. The maximum price Mr. A will be willing to pay for the share if he is of the opinion that 9% growth rate can be maintained indefinitely. Indefinitely means forever. Okay, indefinitely means forever. So that means you will simply apply the formula for second part, D1 upon K minus G. The price of the share at the end of third year. What will be the price of the share at the end of third year if 9% growth rate is achieved, and assuming that other condition remaining same as above? So you have to find P3. So P3 will be D4 upon K minus G. Is it right? D4 upon K minus G will be P3. So the third question you have to find P3, and the instruction is calculate rupee amount up to 2 decimal point. Use present value factor up to 3 decimal point. This question has been asked in earlier exam also, and it was asked in May 21 RTB. So first we will solve part 1, where dividend for the first 3 years will grow at the rate of 9%, and then after 3 years the price will be 720 rupees. So write down. Basic question, sometimes they ask in the exam, and it is a bonus mark. Expected dividend for next 3 years. Expected dividend for next 3 years. Year 1 D1 is equal to last dividend paid is 28. Growth rate is 9%. Very easy question. So 30.52. Year 2 write down. Year 2 D2 will be 28 into 1.09 to the power 2. So the second year expected dividend is 33.27. Check. Is it right? Year 3. 28 into 1.09 to the power 3. 36.26. And the price of the share is 720. Next line write down required rate of return. K is equal to 13%. Presentation for exam purpose. Otherwise directly I can also solve. Market price after 3 years. Market, write down market price after 3 years. This is a presentation technique for exam. P3 equal to 720. So once you have computed the basic data, this is the basic information. Now you can solve. So write down answer. The present value of share is equal to P0 equal to, you can present in tabular format, you can present in equation format. Both are okay. Yes, who will give me the answer? All the students studying at home, kindly reply. P0 equal to D1 upon 1 plus Ke plus D2 upon 1 plus Ke to the power 2 plus D3 upon 1 plus K to the power 3 plus P3 upon 1 plus K to the power 3 again. Anybody wants to reply? One student has already replied 577.15. Rishabh, let me also check. These are the three dividends and 720 is the price. Students are requested to solve. Preeti, 577. Very good. 577.15 is the right answer. Amazing. So you got 2 marks for this much effort. Now those who have done can try second part. In second part, the growth rate 9% will continue forever. So answer of second part, write down. Answer of second part, part 2. Previous answer you got it right, 577. Part 2, write down. If growth rate 9% is achieved, for indefinite period, if growth rate 9% is achieved for indefinite period, then maximum price Mr. A willing to pay, Mr. A would be willing to pay, directly apply the formula D1 upon K minus G. D1 upon K minus G. Rishabh is right. D1 upon K minus G. So that comes to 30.52 divided by 13% minus 9%. 30.52 already calculated. So write down 763. So once again Rishabh got it right before everybody else. Okay. Any query on this? The previous answer was 577.15. Second answer is 763. Now I am going to ask you the third answer. So the competition begins. Please reply third answer. Write down answer of part 3. Assuming that conditions mentioned above remain same. Assuming that conditions mentioned above remained same, the price expected after 3 years will be, try, I am waiting for your answer. What will be P3? P3 will be D4 upon K minus G. D4 will be D3 already calculated into 1 plus G. So see the answer. P3 will be equal to D4 upon K minus G. D3 into 1.09 divided by 13% minus 9%. So one student Rishabh got 988. Preeti Anandam got 988. Okay, 988 point anything is okay. 988 you have reached. You got one more mark. Total 5 marks you will get 2 plus 2 plus 1. Is it right? So that was relatively easy question. So this way we have taken some important question on valuation of share. Mehul has also got it right. Now our next topic would be related to this only. Some formula we have used there will be required in the next topic also, called portfolio management. Is it right? So how many of you like portfolio management? Say yes, we like, or say no, we don't like. Yes or no. Student should reply. Accordingly, I will decide the speed. Do you like? There are some students in classroom who are saying no, we don't like. And somebody is saying we like also. So don't worry. Question number 1, taken from July 2021 exam for 10 marks. So your query would be, do they ask such question in the exam? Yes, that is why it is there. So question, write down July 21, question number 1. Keep the printout ready, and these notes are available on our website vino.in. This is the website VKNOW, vino.in. In the free resource section, you will find these notes. Mr. X is having 1 lakh shares of Messrs. Kanakya Limited. The beta of the company is 1.40. So Kanakya Limited beta is 1.40. Mr. Y, a financial advisor, has suggested having the following portfolio. So what the advisor has suggested, that don't invest in only one share. Instead of that, you should invest in 4 shares, make a portfolio so that your risk will be diversified. SKPD beta, and he has suggested that this should be your percentage of investment weights. These are the weights. And now they are giving you market return is 12%, risk-free return is 8%. You are required to calculate the following for the present investment, that means with beta 1.4 and suggested portfolio, which means you have to find out for this portfolio what you have to find. What is the expected return based on CAPM? Very easy. What is the formula for CAPM? RF plus beta into RM minus RF. Very good. So you have to compute for stock and portfolio. If the market goes up by 2.5%, so market is right now 12, which means here you will take 14.5. If market goes down by 2.5, so it will be 9.5 RM, and if the market gives negative return of 2.5%, so RM is minus 2.5. So with these 3 RMs, you will have to find out the expected return of the stock and the portfolio. If the probability of the market giving negative return is more, that means if you think this possibility is high, there is a possibility market may give negative return, then please, how respectfully they are asking you, please advise Mr. X whether to continue to hold Messrs. Kanakya Limited or to buy the portfolio as per the suggestion of Mr. Y. If so, then why? So you have to answer after computing this answer, and we will see where is the expected return more. Is it right? Accordingly we can suggest. So very easy question for 10 marks. I can't believe that they are asking you such question for 10 marks. I wish I had appeared in this exam. I would have got a rank. Step 1. Calculation of portfolio beta. First I'll get portfolio beta because I need to apply CAPM model for portfolio beta. Portfolio beta is weighted average beta. So concept number 1, portfolio beta is weighted average beta. Students will write security beta weight into beta. Security beta weight into beta. First chance to you. Please try. Mehul, please try. Preeti, please try. After writing the security, write beta given in the question. Weight is given 10%, 0.1. Multiply K 0.75, 0.10, 0.075, 0.40, 0.3, 0.120. Correct? 1.4, 0.5, 0.7. Anybody total of the last column? 1.015. So this I will require for the next 3 answers. Portfolio beta is 1.015. Sidana got it right. Very good. You seem to be a hard working chap. Step 2, write down. Calculation of expected return. First I will calculate expected return. Three columns we will draw. Particulars, expected return, formula write in bracket RF plus beta into RM minus RF, and return percentage write down. We have to compute it for both the stock and the portfolio. The stock name is Kanakya Limited. The original question has RM 12%, RF 8% and beta 1.4 for the stock. 1.4 is the beta of the stock. First line of the question. Question has mentioned in the first line. So the answer for Kanakya Limited is 13.6%. Portfolio based on original market return 12%. Anybody? Portfolio. Come on. You are in a revision batch. Anybody? 12.06. Rishabh Sidana is right. Other students should also reply. Step 3, write down. Expected return if the market goes up by 2.5%. Expected return if the market goes up by 2.5%. So I will again do the same thing. Only I will change RM, which is 12 here. I will make it 12 plus 2.5, 14.5. Please solve. Solve for Kanakya Limited. Kanakya Limited 8 plus 1.4 into bracket 14.5 minus 8. Many students in the exam must be thinking how it can be such an easy question. Something is wrong. Nothing is wrong. This is an easy question. 17.10% is right. Yes, everybody should reply. Next, portfolio. Try yourself. Portfolio. Is it 14.6%? Sure? Very good. You are right. Okay, do the same exercise by writing step 4. Expected return if market goes down by 2.5%. Expected return if the market goes down by 2.5%. So now my RM will change. It will become 12 minus 2.5, that is 9.5. 9.5 you have understood? So 10.1. 10.1. Portfolio. Portfolio. Anybody for portfolio? 9.523%. So that was my answer of part A, B, C. C spending. If the market gives negative return of 2.5%, which means RM will be minus 2.5. Come on, student. Step number 5, write down. Step 5, expected return. If the market gives negative return of 2.5%, if the market gives negative return of 2.5%, only getting answer is not enough. The presentation skill should be there. You are a professional. So I am helping you to learn the presentation skill also. So what is Kanakya Limited return? Anybody for minus 6.7%? Very good. Portfolio. Portfolio. Anybody for portfolio? Portfolio? Minus 2.66%. Minus 2.66%. So who has got a lower negative return? Portfolio has a lower negative return if the market is expected to turn negative. So the question is, second part, if the probability of negative return is more, advise Mr. X whether to continue the holding of Messrs. Kanakya Limited or to buy the portfolio. So should you continue with Kanakya Limited or should you buy the portfolio? In Kanakya Limited the loss will be more. Here the loss will be less. So what is your advice? To buy the portfolio. Right. And the reason for that is beta of the portfolio is less. It will be less volatile compared to the stock. Okay. When there is a possibility that prices will fall, it is better to have investment in stock or portfolio with lower beta. Okay. Write down the note and conclude the answer. I will dictate. Note, if the probability of market giving negative return is more, it is advisable to Mr. X to buy the portfolio suggested by Mr. Y, and then they have asked you why. The answer for that why is because beta of the portfolio is less than Kanakya Limited. Beta of the portfolio is less than Kanakya Limited. So this answer is over. Any query on this? If the market was positive, then the Kanakya Limited investment would have been better. If the market is going to go up, then Kanakya Limited will give you a higher return. Yes. So actually, then we have to also see what is the standard deviation, etc. But the data is not sufficient. So to some extent, it will depend on your attitude toward the risk also. If you're willing to take a higher risk, go with stock with higher beta. Okay, invest in Adani Total Gas. Invest in Adani Power. But people like me invest in ITC, HUL, safe stock, okay, where I know that I won't lose much. So the answer of such question always depends on ability to take the risk. But when they are saying that market is expected to give negative return, then it is better to have lower risk, okay, lower loss. One very good question now coming before you, taken from May 21 RTP. The following information pertains to Golden Limited. PBT, profit before tax, before word underline, which means I need to deduct tax. Tax rate is 30%. Equity capitalization rate means K. Return on investment means R. 18%. Retention ratio means B. 80%. Number of share outstanding 75,000. Keep question in front of you. The market price of this share. Question number 2. What happened? 75 lakh. I made mistake in speaking. The market price of the share of the company in the bull market was. Bull market. What is bull market? Prices are expected to go up. This is bull market. Was somewhere around rupees 2100 per share. So this is the current market price. Advise whether the share of Golden Limited should be purchased or not. So basically you have to apply the formula for valuation of share like the previous chapter and check whether this is overpriced or underpriced. Whether this is overpriced or underpriced. So you have to apply the same formula D1 upon K minus G. Is it right? Retention ratio is 80%. So dividend payout ratio will be 20%. And you can calculate the dividend per share from this information. Okay. After that, you have to check whether it is overpriced or underpriced. After that, another question also suggests the form of market, prevalent market as per EMH theory. Sir, what is EMH theory? EMH, have you heard EMH? Portfolio chapter, there is a concept EMH, efficient market hypothesis. So that is why I took this question. There are 3 levels of market efficiency. One is called weak form, one is called semi-strong form, and one is called strong form. So weak form means technical analysis is useless. Analyzing the past data is useless. Okay. Semi-strong means technical and fundamental analysis is useless. The market already incorporates all the available information. So when you get up in the morning at 9 o'clock, 9:15 the market opens up. You think yesterday night I had read a news. Okay, steel prices will be increased. So let me buy Tata Steel. Tata Steel price at 9:15 has already increased. Is it right? That is called semi-strong. And strong means even insider information is taken care of by the market price. So after solving this, you'll have to answer what is the form of market prevalent as per efficient market hypothesis. So first they have given an instruction also, use Gordon's growth model. So go back to your happy, lucky intermediate days. Gordon model formula. E into 1 minus B upon K minus B into R. Do you remember this? No, it is same formula D1 upon K minus G, because this portion is G and this is your dividend. Earning multiplied by dividend payout ratio is dividend per share. So even if you don't remember this formula, you can write d1 upon k minus g. Both are same. Okay. Now one student Geetika has already replied, share is underpriced, hence bought. Very good. Let me check. So write down step 1. If this question appears in the exam, how will you write the answer? First, we need to find out EPS, and we also need to find out the growth rate. Ready? Steady. Go. Step number 1, EPS and growth rate. First, PBT. PBT in rupees in crore, 75. Then write down less tax at the rate of 30%. 22.5. PAT, write down PAT. How much is PAT? Rupees in crore, 52.5. Then write down number of shares which is given in the problem, 75 lakh, 0.75 crore. In crores, write down in crores. So crore can be divided by crores. Okay. Now who will tell me EPS? Come on. EPS. Anybody? Rupees. EPS in rupees, write down. Nobody has replied. The student learning from home, have you gone into sleep mode? 70 rupees. What is retention ratio? 80%. Very good, Rishabh. What is return on investment in the problem? Return on investment is given in 4th line. Is it 18%? What will you get if you multiply these two? B into R. Growth rate. Very good. Priyanka is also right. Rishabh is right. So my question is, what is growth rate? Yes, Kabra, please reply. Growth rate. So growth rate is 14.4%. Very good. So if you write this much, out of 5 marks, you will get 1 or 2 marks. That is how the marking will be done. Now the step number 2, specifically they have said use Gordon growth model, which is same as dividend discount model. Next line, calculation of market price per share. Calculation of market price per share using Gordon's formula. Using Gordon's formula. Solve. You can use this formula, you can use d1 upon k minus g also. Students have started replying also. Everybody should participate. This will be in your interest also. So apply the formula E into 1 minus B upon k minus g upon k minus g. I'll give you a note for that. This question is not clear whether it is D1 or D0. Okay. So we'll write a note for that. It is assumed that dividend is expected dividend. It is assumed that dividend is expected dividend. Alternatively, you can assume it is past dividend, so you will have to increase it by the growth factor. Accordingly, answer will change. Now write down the advice. Advice, write down the market price is less than intrinsic value. The market price is less than intrinsic value. Therefore, the share is undervalued. Therefore, the share is undervalued. Market price was 2100. But the calculation gives me 2333.39. And if you take D1, the answer will be higher than that. It will be 2669. In both cases, the current market price is less than intrinsic value. Hence, it should be purchased. Hence, it should be purchased. Up to this question was on valuation of share. Okay. Now, they have linked it with the portfolio chapter by asking you to comment what is the form of market efficiency. So, write down, this form of market is a weak form of market. This form of market is a weak form of market. As it is not discounting all the information. As it is not discounting all the information. There is a huge difference between what it should be and what it is. So still there is a gap. It's not a strong form of market. It is not a semi-strong form of market, because in semi-strong form, all published data is already taken into account. So it can be only weak form of market. Okay.
But if it was semi-strong, what information would have been given like that?
These are the information, semi-strong form, company's PAT, company's cost of equity, etc., dividend policy. These are the fundamental information about a company. So in that case, it should have matched.
Similar, not so much.
Not so much of difference. Not so much of difference. Correct. It's the market is a weak form of market, because even though information is publicly available, those have not been considered in the price calculation. So somebody can play with the market and earn super normal profit. Is it right? Like you can do it in this example. By buying this share, you can earn additional income. It should be 2100. It should be 2333, but available at 2100. So that was the reason I took this question, because you will get 1 or 2 marks for writing this small note. Yes, many students will not understand the question only. Some of you did not know EMH full form also. Anyway, now we'll take some advanced question. Some students must be thinking, sir is taking only easy question. Let us take one more question from May 2021 RTP. K Limited, this question they have repeated many times in the RTP, MTP and exams. Okay, past exams. So, a possible question in the exam. Question number 3. K Limited has invested in a portfolio of short-term equity investment. You are required to calculate the risk of K Limited. This is a question. Calculate the risk of K Limited short-term investment portfolio. Risk you have to find of portfolio relative to that of the market. Relative to that of the market. Risk in relation to that of the market. So which statistical number gives you the relationship between the riskiness of the stock or the portfolio in relation to that of the market, whether it is standard deviation, variance, covariance or beta. Which of this gives you the relative riskiness of the stock or portfolio with respect to the market portfolio? Give me the answer. Option A, B, C, D. A is standard deviation, B is variance, C is covariance, D is beta. Those who are from home, they can answer A, B, C, D. Okay. Nobody has answered. We'll come back to this question. Keep thinking. From the following information given below, number of share is given, market price per share is given, beta is given, expected dividend yield is given. The current market return is 20%, RM, and risk-free return is 10%, RF. Advise whether K Limited should change the composition of its portfolio. Should it change the composition of the portfolio? Means should you buy, sell or hold? Right now you are investing in this share. Should you continue to buy, sell or hold? And for that purpose we have to check whether they are underpriced or overpriced. If yes, then how? Note, make calculation up to 4 decimal points. So my question you have not yet answered. Some students have said standard deviation. The answer is no. Standard deviation measures the total risk of a portfolio or a stock. It is not a relative measure of risk. Beta is a relative measure of risk. A beta of 1.5 says that the stock or portfolio is more risky than the market. If market changes by 1%, the stock or the portfolio return will vary by 1.5%. And the data is also given in such a manner that you can only calculate portfolio beta in this. Can you calculate standard deviation or variance or covariance in this example? The answer is no. And how do you calculate the beta? First you have to multiply these two. That will give you value. Convert value into weight. Multiply by beta. That will give you beta of portfolio. After that we will answer this question, should we change the composition of the portfolio or not? Is it right? So one student, Geetika, already answered portfolio beta is 2.93. I have to check your answer, Geetika. You can just try the other questions. In the meantime, let other students solve if you have done it. Okay, so please write down first answer, portfolio beta. So the intention of the examiner is to check whether you can interpret this line properly or not. I am waiting for you. First draw the format. Do not apply shortcut. First column is investment. Second column is number of share. Third column is market price. Fourth column is market value. Then convert market value into weight. Beta, which is given in the problem, and weight into beta. The total of the last column will be portfolio beta. Portfolio beta measures the relative riskiness of the portfolio as compared to market. So please complete the table. I will come in 1 minute. Okay, so are you able to solve? Check the answer. Final answer is 2.93. Geetika got it right. Rishabh, Priyanka, students who are in the classroom, they also got it right. Just check it again. Is it right? 2.93? No mistake? You can't make mistake in such basic questions. Otherwise, you lose mark. This is a bonus mark, 2 mark portfolio beta. The question was, first paragraph of the question, you are required to calculate the risk of K Limited short-term investment portfolio relative to that of the market from the information given below. So market portfolio has a beta 1. Market portfolio has a beta 1, that you know. Always the market portfolio beta is 1. This portfolio of K Limited has a beta of 2.93. So is it relatively riskier than the market portfolio? Yes, write a note. So the first part will be over. The portfolio beta is 2.93. Portfolio beta is 2.93. Thus, the portfolio is risky. Thus, the portfolio is risky compared to the market. Portfolio is risky compared to the market. Now, my next question is whether we should change the composition of the portfolio. Whether we should change the, so for that we will compare two things. In the given question, we can compare required return versus expected return. Required return is calculated as per CAPM. And expected return is given in the problem, expected dividend yield. Can you see that last line of the table? Expected dividend yield. Now you have studied in your portfolio chapter that by comparing these two, you will be able to identify whether the stock is overpriced, correctly priced or underpriced. Is it right? If your expected return is more, if your expected return is more, you're getting more return than what you require, then it is a situation of undervalued. Okay, we'll see. Keep thinking. Right. First we'll compute required return as per CAPM. First we'll compute required return as per CAPM. Write down. Step number 2. Calculation of required return as per CAPM. No, portfolio is not required. Individual security you have to reshuffle. No? In order to check which security I need to buy or sell, I have to do individual stock calculation. For that, first you find out the required return as per CAPM. And the formula is RF plus beta into RM minus RF. RF plus beta into RM minus RF. Just draw two columns. Stock, required return. Stock, write down A. Stock, write down A. And keep the question in front of you. Everybody will understand. The risk-free return is 10% plus market return is 20% minus risk-free return 10% and beta of stock is 2.32. I have written the answer. I would ask you to check it. Is it 33.20? Please check. One line blank. Stock B 55.60. C 28% and D 40%. So one student is saying there is a huge gap between required return and expected return. That is right. But my question is whether the stock is undervalued or overvalued. Let us ask for A. Vote for A. Is expected dividend yield is 9.5%. Expected return is 9.5. So student will have to answer whether it is overvalued or undervalued. Question is open to everybody. Come on, show your intelligence to this world. If expected return, this is expected return, is less than required return, overvalued, it is over, you are getting less. Since you are getting less, it means you are paying more. If you are getting less return, it means you are buying something expensive. Is it right? Expected return is based on the actual price available in the market. If I buy at this price, this is the return I will get. And if you are getting less return, you are buying it expensive. Is it right? So it's overvalued. So all of them are overvalued. You are right. And all of them needs to be sold and you need to purchase other securities. So write down the conclusion. Comparing dividend yield with the expected return of investment, comparing dividend yield with the expected return of investment, as per CAPM, it can be observed that all the investments are overpriced. In bracket for your understanding, expected return is less than required return. expected return is less than required return. If expected return is more than required return, it is undervalued. If they are equal, it is correctly valued. So the conclusion is that they should be sold by K Limited. They should be sold by K Limited and acquire new securities. They should be sold by K Limited and acquire new securities. Okay, anybody, any query now? So this was a good question. Question number 4 now. From your May 19 exam, another question which is repeated. It is a highly repeated question from this topic. Write down, repeat question. And if it is repeat question, it is important also. Many times you can just check. Question number 4. Miss Preeti, a school teacher. Oh, after retirement, oh, has built up a portfolio of rupees 1,20,000, which is as follows. So like the previous question, this is a small repetition, but I will tell you why I have taken it for discussion. These are the 4 stocks, number of share like the previous problem, market price and beta. So you have to again calculate the portfolio beta. Her portfolio consultant, Sri Vijay, has advised her to bring down the beta to 0.8. Is it right? So you have to bring down the portfolio beta, whatever is that right now, to 0.8. So you have to compute first portfolio beta and second, how much risk-free investment should be brought in. How much risk-free investment should be brought in. Because if your portfolio beta is high, then you should bring some risk-free investment. Risk-free investment has a beta of 0. So if you add risk-free investment which has a 0 beta, your portfolio beta will reduce. So what is your target portfolio beta now? The target portfolio beta is 0.8. So for that first you have to compute the portfolio beta. Write down calculation of present portfolio beta. Student will write step 1. Always in the exam, preferably write in the step manner. There is a step marking in the exam system. So more number of steps you write properly, you get more marks. For exam purpose, step marking is important. So dear students, I will give you the format and you will solve and give me the answer. Everybody, come on, Mehul, Rishabh, Geetika, Priyanka. Anybody who got the answer? Suraj, Venu Gopal. So one student in the classroom has given the answer 1.108. 1.1084. Okay. Let me check. Have you got the total value 1,20,000? Then have you got these weights 0.4167, 0.0833, 0.1667, 0.333, and then have you got the total of last column as 1.108? This is a question which first part is a bonus mark, 1.108. Now my next question is, what should be the risk-free investment to be brought in so that your portfolio beta is reduced to 0.8? first chance to you. What should be the weight of risk-free investment? Similar question was asked in November 22 exam also. Write down similar question in November 22 exam. So I am asking you a question to test your revision, how much you know. You have to ensure that this new portfolio, which will comprise of the stock and the risk-free investment, should have a beta of 0.8. So what should be the weight of risk-free investment in that portfolio? What should be the weight of risk-free investment in that portfolio? So you'll have to solve an equation and get it. Weight of shares is 1.108. Sorry, beta of the shares is 1.108. Beta of risk-free investment is 0. So you have to assume weight of one of the two as W, weight of other will be 1 minus W. Is it right? One you can assume W, the other one will become 1 minus W. This you can multiply by 1.108. This you multiply by 0 and you must get 0.8. So don't you think you can find out the value of or the weight of shares and the weight of risk-free investment here? Try. I have given you the answer. You just have to solve it. First you give me the weight, then amount. Portfolio beta right now 1.108. Write down. Anybody who got the answer can reply. Required beta is 0.8. Required beta is 0.8. All of you know beta of risk-free investment is 0. If you don't know, then this point you should know that beta of a risk-free investment is 0. Beta of market portfolio is 1. These two are given in our syllabus. Let the weight of shares, next line, let the weight of shares and risk-free investment be, let the weight of shares and risk-free investment be W and 1 minus W respectively. Is it right? Portfolio beta is equal to weighted average beta. Portfolio beta is equal to weighted average beta. Now I am going to give you an equation you will solve. We want 0.8 as portfolio beta and it is equal to W into 1.108 plus 1 minus W into 0. Correct? So this portion will become 0. So W will be equal to 1.8 divided by 1.108. Kindly answer. So W will be 72.2%. Is it right now? That means these are the shares. So the proportion of shares in the new portfolio would be 72.2%. And what will be the proportion of risk-free investment? 27.8%. These are the proportion or weights we have found out. Now Mehul Rishabh has given correct answer. You have to also write down the amount. Now the shares are 1,20,000. Shares will constitute 72.2% of the total portfolio. So I will get the total portfolio value now, and 27.8% of that portfolio will be risk-free investment. So write down below existing portfolio value is 1,20,000 desired portfolio value, desired, because risky stock shares are 72.2%. So your portfolio value should be now 1,66,205. So can you now tell me what should be the desired risk-free investment? Desired risk-free investment should be 46205. Is it right? 46205. There is one more way you can solve. You can say 1,20,000 I don't want to change. If you don't want to change 1,20,000, then you have to sell some share and buy the risk-free investment. So in that case, you can write this also, alternative 2. In some exam, the institute presents like this. In some exam, they present like this. So we are confused. So when you are confused, what you should do? Write alternative answer also. Yes, it won't take much time. 1,20,000 into 72.2%. 86,640, and risk-free investment. Write both. Yes, actually I used to solve by this method only, but the institute answer is in a different way. So if you don't want to change the value of the portfolio, then alternative 2. And if you are willing to change the value of the portfolio, that is, you don't want to sell the share, but then you have to bring the risk-free investment in that case. Both answers are okay. Institute should make it clear whether we need to increase the value of the portfolio or keep the value of the portfolio same. If you have to keep the value of portfolio same, then you'll have to sell the stocks and buy the risk-free investment. And the stocks will be sold in the ratio of their weights, so that the portfolio beta remains the same. Now let us cross check whether your answer was right or not. You want to cross check or you'll do it in homework? We'll cross check. Yes, whatever you do in this previous example, whether you follow this or this, you write a note in the exam. Okay? Because institute has given both the answers in different exams. They can do anything with you. They are also into a profit making business. How will you survive? Now in the institute answer they have given the proof also that by bringing risk-free investment to this number, your portfolio beta will come down to 0.8, which was actually not a part of the answer. If they ask you prove, then you do it. Okay, so what you will do, you will just take A, B, C, D, E, F, G, H, I, J, K, L same, only add here risk-free asset 46205, beta of risk-free asset 0, solve it and prove that the total will be 0.8. So this is proof. You can take a screenshot if you want, take a photo if you want, write only if asked. Yes, when you solve the equation, it is automatically proved. No, that is what I said. If they say prove, then write it. In only one exam they have done this, other exam they have not given the proof in the suggested answer. So student can solve it by writing the proof or can ignore it. But if the proof is specifically asked, then you have to prepare that table. Is it right? Okay, now we'll take question number 5. Again write down most repeat question. One of the highly repeated questions from this topic is question number 5, and that is the reason I am taking it, even though it may sound easy, it is better to keep ourselves ready. Sometimes easy questions can be more challenging in the exam. Question number 5. As an investment manager, you are given the following information. Okay. So there are 5 columns. Particular price in the beginning, let us call it P0. Dividend, let us call it D1. Market price, it should be market price at the end. Market price at the end. This is beginning price. This is market price at the end of the year, P1. Share or bond, whatever. And the last column is beta. So there is a small drafting mistake. It should be market price of share at the end. Market price of the share at the end. Right. So now we are given shares of 3 companies: Manufacturing Limited, Pharma Auto, and we are given Government of India bond. This question has a very serious mistake. They have given beta of these 3 companies 0.8, 0.7, 0.5, and Government of India bond 0.99. 0.99. It should be 0, but they have given 0.99, which is more than the beta of auto, pharma, manufacturing. Government has also come under risk. So instead of Government of India bond, it should be Government of Pakistan bond. Okay. Then the question will be rectified. B, by assuming risk-free return is 16%. Risk-free return is 16%. I will erase it, otherwise some Pakistani will shoot me from the border. Calculate expected rate of return of the portfolio aggregate of the investor. So what is the overall return of the portfolio? What is the overall return of the portfolio? Second, expected rate of return of portfolio in each. Each means you have to find separately for each of them. So 4 answers will be required. Above stated share using CAPM. You will say, can I use this formula D1 plus P1 minus P0 upon P0? This is also a formula for calculating the return of a period. Is it right? But that is not CAPM. That is not CAPM, because one student had asked this query some years ago, that return is equal to dividend plus capital gain upon the beginning price. You are right. But what is the question? CAPM. So CAPM is RF plus beta into RM minus RF. Beta is given. RF is given. RM is missing. Oh my God. So you have to find out the RM. If you can find out RM, you can solve this question. And then you have to find out the average rate of return. This question they have not properly drafted. Average rate of return of the portfolio. This is one of the controversial questions. Okay. But then in the exam, which they have already asked 6 or 7 times, you can't write it is a controversial question. Hence, I refuse to answer this question. Kindly give me full 8 marks. So first we'll find out RM, and for that there is a trick. Treat that these 4 securities represent the stock market. What will you assume? These 4 securities consist of stock market only, or the market portfolio. These 4 securities represent market portfolio. Then can we find out RM? Yes. This is the total dividend. This is the total market value at the end. This is the total market value at the beginning. So for the market portfolio, I can apply the formula D1 plus P1 minus P0 divided by P0, where dividend will be total of all the dividend, P1 will be total of all the prices and P0 will be total of all the prices at the beginning. Is it right? In fact, that is your first question. Calculate the expected return of the portfolio aggregate of an investor. And then the same question they are asking below, average rate of return of the portfolio. So average rate of return of portfolio will be calculated by applying CAPM. So in order to get the RM, there is no choice but to assume that the given portfolio is a market portfolio. Okay. Please write down. Please write down. Assume that this is a market portfolio.
All questions whichever is asked in the exam.
Similar question if they ask, you have to assume that. Yes, that the given portfolio is a market portfolio. Yes, you have to assume it is market portfolio. So then write down, let us calculate RM. Let us calculate RM. Let us calculate RM. Now write down 4 columns. Investment, initial price, dividend, market price at the end. Market price at the end. So under investment, write down same 3 companies. You can write in short M Limited, P Limited, A Limited. In the exam, don't write short form. And the last is Government of India bond. Government of India bond. Now write down the initial price 30, 40, 50, 100, 1005. Tell me the total of the initial price. 1125. Dividend write down 222. And Government of India bond 140. My God. मोदी है तो मुमकिन है. Everywhere. Market price at the end 55, 65, 140, 1010. Total of the last column. Just check it. Do not copy. Is it right? 1270. So can you now tell me what will be RM? RM will be equal to, write down below, RM is equal to dividend plus closing value minus opening value upon opening value. With formula you have to solve. If you write directly in the exam, the paper checker sometimes they deduct marks. And when we tell them why have you deducted marks, they say this is a poor presentation. Same answer, 2 students get 2 different marks. One gets 8 for the same question, one gets 6 for the same answer. So this is 25.87%. Once you get RM, now the problem is easy. Write down below. So this was my first answer. Expected rate of return of the portfolio aggregate of the investor. So on an aggregate basis, the investor earned 25.87%. Now for each stock we have to compute. Write down please. Write down required rate of return as per CAPM for each security. Required rate of return for each security as per CAPM. required rate of return for each security as per CAPM. Write down the formula RF plus beta into RM minus RF one by one. First write manufacturing limited. For manufacturing limited, the answer is expected return or required return is equal to 16 plus 0.8 into bracket 25.87 minus 16. How much is that? Is it 23.9%? Next, pharma. Pharma is 22.91%. No problem. Some difference in decimal is okay. Auto Limited 20.94%. 20.94%. Okay, approximately. Government of India bond 25.77%. So this is a bonus mark once you get the RM. But many students are not able to get the RM if you have not practiced before going to the exam, because it will not click. And now the next question is average rate of return of the portfolio. So there are two ways you can do it. One is, these are the return of individual stocks. Weights are not given. So assume equal weight. If you assume equal weight, total divided by 4 will give you average rate of return. Second method is, first find portfolio beta. First find portfolio beta. And using portfolio beta, you can find the rate of return as per CAPM. But one problem is there. Weights are not given. We'll assume equal weight. If you assume equal weight, then it is simple average. Okay, so write down. Step 3. Average return of the portfolio. Average return of the portfolio. Just add those 4 answers and divide by 4. How much is that? Add total, divide by 4. $23.38. You can stop here in the exam, but if you want to write alternative presentation, write this also. Alternatively write down. There is no harm in writing just 1 or 2 lines. First we will calculate average beta of the portfolio. We'll check. 23.18. Okay, no problem. You can just check your calculation. If your calculation is right, then go ahead. So now write down, first we'll calculate average beta of the portfolio. First we'll calculate the average beta of the portfolio. Average beta of the portfolio is 0.8 plus 0.7 plus 0.5 plus 0.99 divided by 4, because we are assuming weights are equal. Okay, so you will get 0.7475, and now you use 0.7475 in the CAPM model. If specifically they tell you anything, then we should know the alternative presentation also. Both answers are not required. So write down expected return as per CAPM, RF plus beta into RM minus RF. Please write down 16 plus 0.7475 into bracket 25.87 minus 16. So are you getting 23.38%? Say yes. So you will get almost same answer. Some difference may be because of the rounding off. It's okay. Yeah, they will give you marks. Okay. So that was question number 5, repeated in the exam multiple times. Another repeat question is, and good question is, question number 6, May 17 exam. Okay. This will be a very good question and very important question. Pre-practice is required. The following information are available with respect to Krishna Limited. Jai Krishna. Year. Krishna Limited average share price. Dividend per share. Average market index. Dividend yield. Return on government bond. So these are your risk-free return. Then compute the beta value of Krishna. And at the end of 2015, and state your observation. And state your observation. Whether it is underpriced, overpriced, we will see. So how do you calculate beta in this case? First we have to compute the return of each year. Okay, then you remember the formula of beta, covariance of the stock with the market upon variance of the market portfolio. That is the basic formula of beta. To calculate the covariance, you need to find out the deviation of the x minus x bar into y minus y bar. So we will assume stock is x and market is y, and then accordingly we will solve. First thing we need to find out the x bar, means average return of the stock. Average return of the stock. Okay. First year I can't calculate because the previous year data is not given. But second, third and fourth year we can compute the expected return because the opening prices are given. I will use this formula D1 plus P1 minus P0 divided by P0 to calculate the return of the respective year. 2012 we are not calculating because opening balances are not available. Okay. So first 2013 I will show you, and then you will calculate (2013 is 12.24%). Say yes. 2014. Anybody? 2014. 2014. Check. (32.41%). 32.41%. 2015. 2015. 2015 is 16.13. 16.13. Is the answer right? Then take the total of the last column. Total is 60.78. Divide by 3. That will give you 20.26%. Is it right? 20.26% is right. This is your average return of the stock. Now we'll do the same thing for market, but in case of market, I will also have to add the dividend yield which is given in the problem. So market also will give me appreciation in percentage by comparing the opening and closing balance. To that I will add dividend yield, and that will give me total market return, capital yield plus dividend yield. So write down step 2. Very good question. On your own you can make mistake in the exam if you have not practiced. Here calculation percentage of index appreciation, dividend yield in percentage, total market return, total market return. One I will show you, other two you will calculate. 2013. Now don't use 2012 line because opening balance is not there. In 2013 the closing is 2130, opening is 2013, divided by opening 2013. So that gives you 5.81% appreciation, correct? Say yes. Plus 5%, market return is 10.81%. Is it right? Now try 2014. 2014 try. 16.33% you are getting. Very good. Everybody should try. 2015. 2015 try. 16.79%. So what is the total? $43.93 divided by 3. Divide by 3, you will get 14.64%. Is it right? 14.64%. Right. So I have got average return of the stock, average return of the market index. So can I not calculate now? Can I not calculate beta now using the formula covariance upon variance of the market? Yes or no? So using that basic knowledge of this chapter, beta is the ratio of covariance of the stock with the market upon variance of the market portfolio. So we will assume stock is X and market is Y. Very important question. 8 marks if you have done the practice in advance. So write down 2013. Now go to your step number 1. You will find this returns figure there. Year wise return 12.24%, 32.41%, 16.13%. Market return from step 2, 10.81%, 16.33%, 16.79%. Then I will compute x minus x bar. X bar means the average return of the stock 20.26%, correct? Take 12.24 minus 20.26. Practice is very important in this chapter. Otherwise students don't know which column to draw, what should be added, deducted. So anybody wants to reply x minus x bar. Is it minus 8.02? Below that, second year. 12.15, very good. Year 3, minus 4.13 is right. 8 mark, bonus mark, but you should know it. Anybody for y minus y bar? Take 10.81 minus 14.64, come on. Minus 3.83. Again, take 16.33 minus 14.64. 1.69. Is it 1.69? Last one. 16.79 minus 14.64. 2.15. Now what you will do? Multiply these two. X minus x bar into y minus y bar. If both are negative, write positive number. If both are positive, write positive number. One is positive, one is negative, write negative number. Check. Done. Check the answer of second last column. Are you getting positive 30.72? Say yes. 20.53. 20.53 is right. Minus 8.88. Total. Check total. Minus 8.88. Take total of these three numbers. 42.37 you are getting. 42.37. 42.37. Is it right now? Now take y minus y bar square. Take this column and take the square. 3.83 into equal to you'll get 14.67. 1.69 into equal to, that is the trick, 2.86. 2.15 into equal to 4.62. Take total 22.15. So what will be the beta now? This divide by this, correct? Right. So dear student, now you write below that beta equal to formula summation x minus x bar into y minus y bar upon summation y minus y bar square. Y minus y bar square. Y minus y bar square. So that is 42.37 divided by 22.15. 1.913. Okay, 1.913 seems to be right. Now write down observation. Observation they have said, but not clearly exactly what they want us to observe. We want to check whether the stock is overpriced, underpriced, and what action should be taken in each year. So observation, write down. Observation. CAPM return, actual return, and action. CAPM return, actual return, and action. So first I will solve, next two you will solve. Risk-free return is based on government bond. You are right. So first year, the CAPM return was 6 plus, what was the beta? 1.897? Beta is not given. Beta is not given. This is your computed, no? That is by mistake. You take 1.91. Whatever beta you have got, take the same figure. I think I have made a mistake in writing here. You can take the same beta which you have got in your previous answer. Return on market was how much? 14 point? No, for that year. For 2012-13. 10.81. Correct. We are doing year-wise calculation. So is it 15.12? Then actual return is how much? Actual return is 12.24. Actual return is less than CAPM return. So it is overvalued. The action would be sell. The action would be sell. The action would be sell. Okay. Risk-free return is given in that last column. 6%. 6%. Yeah. 15.20 is okay. Try the next one. Anybody wants to reply the next one? What is your CAPM return here? 25.60. What is actual return in that year? Can you see this 32.41 in your step 1 answer? Step 1, is it there? Yes. Now this year your actual return is more than the CAPM return. So you should buy. It is undervalued. It is what we call positive alpha. Is it right? What we call it? Positive alpha. Positive alpha means your actual return is more than CAPM. So that means you should buy. Here it is negative alpha. Negative alpha means sell. This is 25 point how much? 76. Okay, very good. So learned student, please do the last year yourself. How much is the answer for last year? Yes, come on, CAPM return. Nobody is replying. Where have you gone? Is it 26.47 approximately? 26.64. 26.64. And what is your actual return? Last third year, 16.13 is there. 16.13 is there. Your answer is sell. Good question. Cabra has also got the same answer. Now in this year actual return is less, so sell. This is negative alpha. Negative alpha stock should be sold. Okay. So there is one more question pending. Should we do it today or tomorrow? Tomorrow. You are tired? Okay. So now we will continue tomorrow. Hello, good morning. Please come to question number 7 now. Question number 7. Mr. X owns a portfolio with the following characteristic. Factor 1 sensitivity, security A 0.80, that is beta for security A. This is beta. Security B 1.50. This is beta of security B for factor sensitivity. Risk-free security has a beta of 0. Factor 2 sensitivity is 0.60. Factor 2 sensitivity for security B is 1.20 and risk-free security beta is 0. Expected return is 15%, 20%, 10%. This is the expected return of security A, security B and risk-free security. 10%. Risk-free security return is 10%. It is assumed that security returns are generated by a two-factor model. It is a two-factor model. Factor 1, factor 2. Factor 1 can be anything like inflation, GDP. Factor 2 can be something like interest rate, market, okay, industrial production. So we don't know. Mr. X has rupees 1 lakh to invest and sell short rupees 50,000 of security B. So how much amount he has? He has 1 lakh rupees. He has 1 lakh rupees and he sells short 50,000 of security B. So he will get 50,000 rupees by selling security B. When you do the short selling, you get the money. So this is 1,50,000 he has now and purchases rupees 1,50,000 of security A and he buys security A worth rupees 1,50,000. 1 lakh his own money, 50,000 from short selling of security B. Investment in A is 1,50,000. B we will say minus 50,000. Short selling will be given a negative weight. Short selling will be given a negative weight. Okay. Always remember, short selling or borrowing will be given a negative weight. Question is, what is the sensitivity of Mr. X portfolio to the two factors? So you have created a portfolio which has two stock. Stock A rupees 1,50,000, stock B minus 50,000. Stock B minus 50,000. Is it right? So you have to find out the sensitivity of Mr. X portfolio to the two factors. So portfolio sensitivity you have to find for factor 1 and factor 2. Portfolio sensitivity is always equal to weighted average beta. So basically we have to first find out how much weight you have allocated to A and how much weight you have allocated to B. Is it right? Second question will come to this again, very easy. Mr. A borrows, if Mr. X A borrows 1 lakh, already he has 1 lakh rupees. He own money 1 lakh, borrowed money 1 lakh. So right now he has how much? 2 lakh rupees at the risk free rate. Borrowing will be given a negative weightage. Is it right? And invest the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1. As described in part 1 means this is the part 1. In part 1, own money was 1 lakh. Short selling of B was 50,000, correct? Now you have 2 lakh rupees. Now you have 2 lakh rupees. How much will be short selling? The amount of short selling in B is half of the funds that is available to you. In the first question, short selling in B was 50,000 when the amount available was 1 lakh. Now the amount available is 2 lakh. So what will be the short selling of security B? Is it 1 lakh? 1 lakh. So B will be short sold 1 lakh. So total amount you will have now 3 lakh. By selling B, short selling, you will get funds equal to 1 lakh. So 3 lakh. So my investment would be now in 3 items. A will be 3 lakh, B will be minus 1 lakh, and risk free asset, that is borrowing, will be 1 lakh negative. So you will have to calculate the weights. You will have to calculate the weights. And by calculating the weights, after calculating the weights, you will be able to calculate the portfolio beta for factor 1 and factor 2 by applying weighted average beta. When you have more than one factor, we calculate weighted average beta for the portfolio. Is it right? So these two questions are same. Only in this question they have added borrowing also. And the third question is, what is the expected return premium of factor 2? What is the expected return premium of factor 2? So this is based on arbitrage pricing model. The expected return of a stock is equal to beta of factor 1 into risk premium of factor 1 plus beta of factor 2 into risk premium of factor 2, okay, plus risk free return, and that should be equal to 15%. So we'll have to solve an equation because risk premium is missing for factor 1 as well as factor 2. So by solving a simultaneous equation, you will be able to find out the risk premium for factor 1 and factor 2. Very important question. It was asked in the exam. So write down answer of first part. Answer of first part, write down. Answer of first part. Own fund. First I am going to explain so that in future if they ask you this question, you can answer better. Own fund is 1 lakh. Short sale of B 50,000. Short sale of B 50,000. Total is 1,50,000. Total is 1,50,000. Amount invested in A. Amount invested in A amount invested in A, so 1,50,000, and B is minus 50,000. B is minus 50,000. B is minus 50,000. Okay. Then you write down Step next, computation of weights. Computation of weights. Under computation of weights, draw 3 columns. Presentation is very important. You may blame me for taking little more time, but it is important. First, write down stock A. Total investment A is 1,50,000. Divide by 1 lakh. How did you get 1 lakh? 1,50,000 minus 50,000. So the total is 1 lakh. So the denominator will be 1 lakh. Okay, the denominator will be 1 lakh. Now write down weight 1.5. This is very important. What mistake students do? They write 1,50,000 divided by 1,50,000. So they write 1, but that is not right. Is it right? Now write down next point, minus 50,000 divided by 1 lakh. This weight will be negative because it is short. So the total should always be 1. Total should always be 1. Total should always be 1. Now write down sensitivity of Mr. X portfolio. Sensitivity of Mr. X portfolio to the 2 factors. Sensitivity of Mr. X portfolio to the 2 factors. Sensitivity of Mr. X portfolio to the 2 factors. Factor, calculation and beta. Factor, calculation and beta. Factor, calculation and beta. Factor, calculation and beta. So you just have to apply the weighted average formula. Okay. 0.8 into 1.5, that is weight, then factor 1 beta 1.5 into 0.5 into minus 0.5, sorry, negative weight, is it 0.45? Is it 0.45? Now try factor 2 yourself. Try factor 2 yourself. Try factor 2 yourself. Factor 2 weights will not change, this factors will change, no? Factors will change. 0.6, can you see in the question book? Risk-free rate will come in the second part of the answer. First part of the answer does not have any risk-free. Okay. So 0.6 into 1.5 plus 1.2 into minus 0.5. 0.30. So this was so easy. Only you have to get the weights correctly done. Okay. Now we'll write down third answer. Answer of part 2. Answer of part 2. For that I need to first find out exactly how much amount was invested in A Limited. Write down answer of part 2. Write down answer of part 2. Answer of part 2. Under that write down own fund 1 lakh. borrowed fund 1 lakh, borrowed fund is also 1 lakh, total we have 2 lakh. So you just draw a line and write 2 lakh here, 2 lakh, total 2 lakh, total 2 lakh, total 2 lakh. Short sale of B, write down, short sale of B, short sale of B, 2 lakh divided by 2, 2 lakh divided by 2, 1 lakh, 2 lakh divided by 2, 1 lakh. Why it is divided by 2? Because they are saying that, one good question, you have to take the same ratio which you have followed in question number 1. In question number 1, you had 1 lakh rupees money, short selling in B was 50,000. Now you have 2 lakh rupees. So what will be the short sale of B? You have to follow the same proportion. Okay. So 1 lakh rupees is this 2 lakh divided by 2, because half of the funds available is the short selling in security B. So now the total funds available after short selling is 3 lakh. Total fund available after short selling is 3 lakh. Total funds available after short selling is 3 lakh. Now the breakup of that 3 lakh is A Limited 1 lakh, borrowing is 1 lakh, and B Limited minus 1 lakh, and B Limited is minus 1 lakh, and B Limited is minus 1 lakh, and B Limited is minus 1 lakh. Why minus 1 lakh? Short selling. Two things note down. Two things note down before I proceed further. For short selling and borrowing, write down students, short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. Okay, now we'll give the weights. Next heading, write down amount invested in security A. Amount invested in security A. In fact, this you don't need to write, we have already done. Just wait. Now step next, write down computation of weights. Computation of weights. Computation of weights. Computation of weights. Risk-free asset, write down minus 1 lakh divided by 1 lakh. Why 1 lakh rupees in the denominator? Why 1 lakh rupees in the denominator? 3 lakh is the investment in A. 1 lakh is borrowing. 1 lakh is short sale of B. So the total will be 1 lakh. Total will be 1 lakh. Write down. Total is 1 lakh. Denominator one more note, write down for your future reference. For students who might get confused at a later stage, denominator will always be own funds. Denominator will always be own funds. Denominator will always be own fund. Denominator will always be own funds. Right? Now using these weights and multiplying by the factors, factor beta, you will be able to calculate the portfolio beta for the two factors. Okay. Write down last step for part 2. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. Just a minute. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. First write down factor 1. First write down factor 1 minus 1 into 0 What is minus 1? Minus 1 is weight of risk-free asset. What is minus 1? It is weight of risk-free asset. This is the factor sensitivity of risk-free security. Plus, what is 3? 3 is the weight of security A into 0.8. 0.8 is the factor sensitivity of security A. Plus minus 1 is the weight of security B, and this is the factor 1 sensitivity for security B. Just do the calculation. Just do the calculation. Is it 0.9? Is it 0.9? Right. You will try factor 2 so that I will understand that you are understanding it. Factor 2. Factor 2. Come on. One student has replied 0.6. Very good. Factor 2. Same calculation, minus 1 into 0 plus 3 into 0.6 minus 1 into 1.2. When you solve it, you will get 0.6. This is your second answer. That was so simple. Yes or no? Now the next task is to calculate the factor return premium for second factor, which means you will have to solve an equation. Which means you have to solve an equation because there are two risk premium in this question. Risk premium for factor 1, risk premium for factor 2. So therefore I will solve an equation. So write down, heading write down at the top, you can see the heading, calculation of expected return premium of factor 2. Calculation of expected return premium of factor 2. Calculation of expected return premium of factor 2. Then write down, let expected return premium of factor 1 be F1 and factor 2 B F2. So equation will be expected return minus risk-free return, or you can write risk-free return on the right side plus RF, just like CAPM model, risk-free return plus premium. So what I have done to save your time and effort, I have brought this RF on the left side. If you are interested, you can write on the right side plus RF. Okay, this will just help you to save time. Numbers will come on the left side, equation will come on the right side. That was the intention. There was no bad intention. Okay. After that, you write down for security A, 15% is the expected return. Can you see in the third line of the table? Minus risk-free return 10%. Minus risk-free return 10% is equal to 0.8. Can you see factor 1 0.8 beta? 0.8 security A, factor 1 beta 0.8 in the question into F1 plus 0.6 into F2, 0.6 into F2, 0.6 into F2. For security B, write down, or first I'll simplify it for you. 5 is equal to 0.8 F1 plus 0.6 F2. Is it right? For security B, write down, question in front of you, expected return is 20 minus 10 नहीं दिख रहा है क्या? ठीक है, तो हाँ करो 1.5 F1 plus 1.2 F2. Okay, so simplify this. 10 is equal to 1.5 F1 plus 1.2 F2. Solve equation 1 and 2. Solve equation 1 and 2. Solve equation 1 and 2. Anybody wants to answer? What will be the answer for this? Solve equation 1 and 2. F1 is equal to 0. F2 will be 8.33. How do you solve the equation? That is not my duty. You are a CA finalist, some days away from your exam. You have to solve. How do you solve the equation? That even I don't know. I also forgot. So you can just multiply this by 2. If you multiply this by 2, it will become 10 is equal to 0.8 F1, sorry, 1.6. See, I have also forgotten. I have never done equation in my school also. Plus, wait, 1.2 F2. No, I think I have made some mistake. Anyway, let me try. This is 10 is equal to 1.5 F1 plus 1.2 F2. Something is wrong. So minus minus minus. So this will be 0. This will be 0.1 F1 and this will also be 0. Is it right? So which means F1 will be equal to 0. Something like this. See, I am not very sure and today is not the time to teach the equation. So this way you are going to crack the equation. Right? So write down, later on you can try as homework. If students are not getting F1 and F2 as this number, when you are free you can take coaching from your brother or sister who are studying in 4th or 5th standard and they will help you. So my answer is over now. Therefore the expected return premium of factor 2 is 8.33. Therefore expected return premium of factor 2 is 8.33. Now this question is very important. If you have not done practice before going to the exam, then you will have a challenge. Okay, one thing you should know how to solve the equation, and the other important thing was how to assign the weight. How to assign the weight. So that was a discussion on portfolio management. Just we'll wait for a minute. So the next topic is mutual fund. Most of the student must be happy. This is a very easy topic and you must have done similar questions also. So mutual fund topic. Question number 1. Are you ready? Say yes. Mutual fund question from July 2021 exam for 5 marks. The AMC of a mutual fund has declared a dividend of 9.9% on the units under the dividend reinvestment plan for the year ended 31st March 2021. So what is the rate of dividend? 9.98%. Dividend is always paid on the face value. Dividend is always paid on the face value. The investors are issued additional unit for the dividend at the rate of closing NAV for the year as per the condition of the scheme. This is a reinvestment plan. This type of plan is called dividend reinvestment plan. Have you studied dividend reinvestment plan? So you will calculate the number of units reinvested. You will calculate the number of units reinvested. Right? Number of units reinvested. And number of units reinvested is equal to dividend divided by NAV, which in this question they are saying it is equal to closing NAV. Okay. Next line. This question is very, very important. I am going to ask you also to solve and you will check your intelligence. The closing NAV was 24.95 on 31st March 2021. An investor, Mr. X, who is having 20,800 units at year end, underline. So this fellow is holding 20,800 units at year end, means this is after adding the number of units reinvested. This is after adding the number of units reinvested, has made an investment in the units before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. So how much he has paid for the unit opening NAV plus 0.04. This fellow has paid at the rate of opening NAV plus 0.04. Understood? Next line. The NAV has appreciated by 25% during the year. So opening NAV plus 25% appreciation will be equal to closing NAV, which is 24.95. Can you see 24.95 here? Assume the face value of the unit is 10 rupees. So this 10 rupees will be required for multiplying by 9.98%. So that will give you dividend per unit. That will give you dividend per unit. Question is calculate the opening NAV. Very easy question. Calculate the number of units purchased and calculate the original amount of investment. In this question, I am going to test you. So are you ready for the test? Please reply to my first question. Everybody is invited to reply. What is the opening NAV? My first question, please try opening NAV. What is my opening NAV? Students are requested to reply. What is my opening NAV? Please try. Opening NAV plus 25% appreciation is equal to closing NAV. So let the opening NAV be X. Let the opening NAV be X. Mehul Garg has replied, let me check. So the equation will be X into 1.25 is equal to 24.95. Correct? Say yes. If you don't say yes or no, how will I understand? Therefore, opening NAV will be 19.96. Opening NAV is 19.96. This was not a question. This was a bonus mark. Okay. This was a bonus mark. Next question. Again, you will participate. You will participate. Let me see who gives me the correct answer. Calculation of number of units purchased. Please reply everybody. Calculation of number of units purchased. Calculation of number of units purchased. Waiting for your answer. This is a question of dividend reinvestment asked in the exam. So the number of units purchased, we have to solve an equation x plus number of units which you are going to reinvest, and that should be equal to closing unit which was given to you 20,000 how much? 800. So the student will have to again solve an equation. Please check whether you can get it right or not. Yes. My question is, what is the number of units purchased at the beginning? Let the number of units purchased be X. Write down. Let the number of units purchased be X. Let the number of units purchased be X. And then you have to write down dividend per unit. Dividend per unit. Dividend per unit will be 10 into 9.98%. 10 into 9.98% means dividend per unit is 0.998. 0.998, correct? Then total dividend received. Total dividend received will be number of unit is X. Dividend per unit is 0.998. So 0.998x. 0.998x. Now therefore Therefore, number of unit reinvested will be 0.998x divided by 24.95, which is the rate at which number of units were reinvested. Correct? Number of unit reinvested is total dividend divided by the rate at which dividend was reinvested, 24.95. So now I am going to write a simple equation. Total number of units after reinvestment is 20,800. Total number of units after reinvestment is 20,800. So the equation will be, anybody wants to reply now? Solve the equation and reply. Come on, students, please write. X plus 0.998x divided by 24.95 equal to 20,800. Who wants to answer? Yes. Please answer.
12,000.
Is it 20,000? One student got 20,000. Very good. 20,000 is right. That was not very difficult question, but very few students are able to solve it by writing this equation. Any other person who wants to reply? What is my third question? What was the original amount invested? Write down. Calculation of original investment amount. Calculation of original investment amount. Calculation of original investment amount. Right hand side amount. Right hand side amount. At what rate he has purchased? He has purchased at the rate opening NAV plus 0.04 entry load. So the amount you are going to pay is opening NAV plus 0.04 and multiplied by 20,000 units. Say yes. Write down. Please write down. This question you may not have solved in your regular classes. Opening NAV 19.96. Opening NAV 19.96. Question says entry load was paid. Add entry load 0.04. Add entry load 0.04. Therefore, selling price per unit. Therefore, selling price per unit is 20. This is the rate at which mutual fund has sold units to the investor. Point D, write down number of units purchased. Number of units purchased. Number of units purchased is, as per step 2, 20,000. Now who will reply? Let me see who will reply first and fast. Total amount of initial investment. Come on, reply fast. Total amount of initial investment. Total amount of initial investment will be 20 rupees per unit into 20,000. C into D. Mehul Garg is saying 4 lakh rupees. Very good. 4 lakh rupees, right. If you practice in advance, you can do it fast in the exam, because there are equations to be solved in this question and there are concepts involved in this question. So now, learned students, please come to question number 2. This is also from exam for 4 marks, and this is also a reverse working question. Mostly in the class we learn to solve question in a straightforward manner, But in the exam they give you reverse working question. From the last step, you have to find the answer which is at the beginning. Okay, so one more practice, and I will expect all the students should participate. Mr. Strong and AMC has floated a dividend bonus plan. In this question, they will get bonus unit. In the previous question, they had reinvested the dividend. Now here you will be given bonus unit. On 1st April 2016, at a certain NAV. At a certain NAV means this is your missing question. This is what we'll have to find. It's printed here also. Question mark. The fund has a robust growth and has declared a bonus of 1:5, and they have interpreted one bonus unit for 5 existing unit held, 5 right unit held, correct current unit, 1:5, and a second bonus of 1:4, one more bonus. Bonus is reigning. On 30th September 19, the fund has generated on 31st March 2021. When was the issue made? 1st April 2016. And this they are talking about 31st March 21. So how many years are over? 4 years are over. Or 5. 17, 18, 19, 20, 21. Is it right? 2017, 18, 19, 20, 21. 5 years are over? 5 years are over. So after 5 years they find that the average yield is 17.5%. That means the investor has earned on an average 17.5% per annum. So in 5 years time, how much he has earned? Multiply. 87.5% he has earned. The Mr. Optimistic has made an investment of 16 lakh. So if you invest 16 lakh rupees today with 87.5%, you can find out what will be its value after 5 years. Yes or no? Yes. In the plan before the declaration of the first bonus and remain invested thereafter. So he has invested 16 lakh on 1st April. By adding 87.5%, you can calculate what is the value he will have been after 5 years. The following information is also available. You have to find out the NAV on this date. They have given you NAV on 39/2017, 39/2019 and 31st March 21, 100. You are required to advise to Mr. Optimistic the opening NAV which is required by him to calculate the capital appreciation. So first chance to you. Students will try. You have to find out the opening NAV. I'll give you 30 seconds to try. Then only your mind will work. You will think. So 30 seconds starts now. Seconds starts now. Anybody wants to reply? Students who are studying at home, they can also reply. Yes, please reply. Anybody, any answer? So far, no answer. What was the NAV on 1st April 2016? You have studied mutual fund chapter. Okay, so let us do the reverse working. Let us do the reverse working. This is a question of reverse working and you will be able to solve. So first I will find out number of units on 31st March 2021. Number of units on 31st March 2021. Number of units I can calculate on 31st March 2021. We know the value of our investment. We know the NAV per unit. Value divided by NAV per unit can give you number of units on 31st March. And then you do reverse working and you can calculate the number of units at the beginning and then you can compute the NAV at the beginning also. Yes, I know this is a tricky question. First time very few students can reply correctly. Write down. Don't worry. That is why I am taking such question. It will be useful if it appears in the exam. First write down point A. Amount invested on 1st April 16. Amount invested on 1st April 16. Amount invested on 1st April 16. 16 lakh. Then write down number of years, number of years write down 5 years, number of years 5 years. Average return write down, average return 17.5%, average return 17.5%. So multiply point B and C, that will give you total return multiplied by 16 lakh also. So that will give you total gain. Total gain during 5 years. Total gain during 5 years. A into B into C. A into B into C. 14 lakh is your gain. Therefore, closing investment value 30 lakh. You can write 30 lakh directly if you can get it, no problem. And what is the closing NAV on 31st March 21? 100. So can you find out the number of units? Number of units will be 30,000 on 31st March 21. Now can you do reverse working and reach the opening number of units? Opening investment is 16 lakh. Divide by opening units, you will get the opening NAV. So now you have to do reverse working and find out the number of units on this date. Right now you have 30,000. There was one bonus 1:4, 1:5. So you have to find out number of units at this point. This is simple common sense now. Write down step 2. Number of units on 1/4/16. Number of units on 1/4/16. Please reply. I am giving you a chance to reply. 4 columns we will draw. Date, unit held after bonus. Unit held, write down after bonus. Unit held after bonus. This word after should come here. Unit held after bonus. Bonus ratio. Bonus ratio. Unit held before bonus. Unit held before bonus. Okay. Unit held before bonus. So first write down reverse working I have to do. I will write 30th September 2019. 30th September 19. Bonus ratio is 1:4. Unit held was 30,000. So can you tell me how many units were held before bonus? 24,000. Now write down 30th September 17. 24,000. 1:5. So 1:5, you will take 5/6 into 24,000. If there are 5 shares plus 1 bonus share, you have 6 shares. So the ratio is 5 unit before versus 6 unit after. So 5/6. That is the logic. 20,000. Now write down step 3. NAV on 1,416. NAV on 1,416. These two questions probably you have not done in the class. Okay. Right hand side rupees. Amount invested. Amount invested. Yes, why are people not replying? 16 lakh. Then point B, number of units. Step 2, 20,000. Write down. Number of units 20,000. My question is, what was the NAV on 1,416? Yes, come on. NAV per unit. Yes, yes, reply. Is it 80 rupees? Yes. Finally, we reached the answer. But it took some time. Nowadays in the exam, they are asking such reverse working question. Okay. Anybody, any query? Please reply yes or no. Query, yes or no. It was easy question, but if you are in the exam hall, then you may not have so much time to think, and it is only for 4 marks. So you can't dedicate 20 minutes on this. So pre-practice is required. Now the next topic is derivative. Under derivative topic, we will discuss future option and interest rate derivatives. Okay. So lengthy topic. So first I am going to take derivative futures. What is a future contract? A future contract is a right as well as an obligation to buy or sell a specific quantity of a specific underlying at a specific rate on a specific future date. It is a right as well as an obligation. Futures are traded on the exchange. Forward contracts are over the counter. So we are going to take one November 2020 question from RTP. Question number 1 from November 2020 RTP. Quite important question. Write down. Again, pre-practice is required. Otherwise, in the last minute of the exam, you might make some mistake. So write down, very important for upcoming exam. Mr. SG. Underline this word sold. Sold means he has taken a short position. Short position holder will make profit if the price goes down. So he is betting on downward movement of price. He is expecting that Nifty will fall. 5. 5 means lot, number of lots. 5 is number of lots. 4 months. 4 months means the maturity period. This future will mature after 4 months. 4 months, here is the maturity period. Nifty future on 1st February 2020 for rupees 9 lakh. At the time of closing of trading on the last Thursday of May 2020, that is after 4 months, February, March, April, May, what is the actual index turned out to be? 2100. Actual index turned out to be 2100. The contract multiplier is 75, which means for one lot you have 75 units. So he has bought how many lots? 5 lots, 375, and he has taken it for 9 lakh rupees. The 9 lakh divided by 375, how much? 2400. So basically he has taken a short position on 2400 and market has actually gone down to 2100. So he will have a profit of 300 rupees per unit into 375. Into 375. So that will be his profit. That is a basic calculation. Based on the above information, calculate. You have to do reverse working again. The price of the one future contract on 1st April 2020. So 1st April 2020, the price of the one future contract is 2400 per unit and one lot is 75. So you can calculate the price of one future contract. Approximate Nifty index on 1st April 2020. You have to find the spot Nifty on that day. You have to find spot Nifty. Spot Nifty into e to the power RT is equal to future Nifty. Is it right? So reverse working and find the value of S. Approximate Nifty index on 1st February if the price of the future contract on the same day was theoretically correct. Theoretically correct means it follows this equation. Spot price plus interest effect is equal to future value. So you have to find this value. This is 2400, which we have already calculated in the first part. On the same day, risk-free rate is, and in dividend yield is 9% and 6%. So the formula will be e to the power r minus y into t. When yield is also given, r minus y. Maximum contango or backwardation. This I will tell you later. The payoff of the transaction means profit. That we have done 300 into 375. Carry out the calculation on month basis. So 4 months. Wherever applicable, 4 months. You can do calculation on days basis also. But that will be little more complex. Right? So please write down the answer one by one. Everybody should participate. Price of one future contract. Price of one future contract. Total contract value. Total contract value divide by number of contracts. You will solve and give me the answer. 9 lakh divided by 5. 9 lakh divided by 5. 1,80,000. Is right now? Right. Now next step 2. Step 2, write down price of index future on 1st February 2020. Price of index future on 1st February 2020. Price of index future on 1st February 2020. So under that write down value of one future contract, value of one future contract divide by contract multiplier, divide by contract multiplier. That is equal to 2400. So this is the number I am going to use in the other two answers. This is the Nifty future at which you have entered into a contract. You are betting that Nifty future after 4 months will go below 2400. Now your question is, what was the Nifty index on 1st February 2020? I know the future value. I have to find the spot value. So write down the formula. This formula is used when dividend yield is given. This formula is used when dividend yield is given. S into e to the power interest rate minus yield into time. If yield is not given, then the formula is S into e to the power RT. If yield is given, then it is deducted from the interest rate. So the student will have to now solve an equation. Nowadays they have started asking reverse working question. Future value is 2400 as per previous calculation is equal to X into spot price, assume X, 2.7183 to the power 0.09, which is the risk free rate, minus 0.06, which is yield, into 4 by 12. So first what you do, it's not difficult, you can do it. Simplify the power. 0.09 minus 0.06 into 4 by 12. Is it 0.01? Yes. In the SFM classes, we tell you how to solve this part. Is it right? By using your calculator, you can do it. First, you type 2.7183. Press square root 12 times. Minus 1 multiplied by 0.01 plus 1 multiply equal to 12 times, multiply equal to 12 times. So you will get 1.01005 you are getting, 1.01005 you are getting. So the value of the X will be, write down X equal to 2400 divided by 1.01005. I am waiting for your answer now. Is it correct? So how much you are getting? Final answer. What is the final answer? Yes, everybody. Mehul Garg is saying 2376. Very good. Anyone else? Okay. So that was my part 2. Only one note write down. Note write down, because institute sometimes does not take continuous compounding. So if you are taking continuous compounding, write a note. It is assumed that interest is compounded continuously. It is assumed that interest is compounded continuously. It is assumed that interest is compounded continuously. If they specifically say that interest is compounded continuously, then you have to do it. Otherwise, do it and write a note. Otherwise, you take compound interest and write a note. Our next question is, what is the maximum contagio or backwardation? I will give you a note first. Yes, VV Ranglesh, you are also right. Sorry, Rangaiya. VV Rangaiya is also right. First time you have answered. 2.7183. That is the value of E. Value of E is 2.7183. This they teach in SFM batch. Have you not studied SFM? You have not studied this chapter. Oh my God. Oh my God. Directly you have come to exam without studying derivative. Okay, so it is quite possible that some students have not studied this. Okay, so can we continue now? Write down the note on maximum contagio or backwardation. Maximum contagio or backwardation. First write a note. In a normal market, the spot price is less than. In a normal market, the spot price is less than future price. In a normal market, the spot price is less than future price. And accordingly, the basis would be negative. And accordingly, the basis would be negative. Such a market is known as contagio market. Such a market is known as contagio market. Basis is negative means spot price minus future price is called basis, and if it is negative we will call it contagio market, means spot price is less than future price. Okay, now write down next line. Basis is equal to spot price minus future price. Spot price minus future price. Basis is equal to spot price minus future price. 2376 minus 2400 is equal to 24 negative. It's called 24 negative. It means your spot price is less than future price. and if it is negative, the market is said to be in contango. The market is said to be in contango. The market is said to be in contango. If the basis is negative, the market is said to be in contango. Therefore, maximum contango equal to maximum contango equal to 2400 is your future price, 23,676 is your spot price, 24 rupees. Okay, so the formula for basis is spot price minus future price. If it is negative, it is contango. One more question. Okay, next line, write down calculation of payoff on the future transaction. Calculation of payoff on the future transaction. The payoff on the future transaction would be dependent on whether it is a long position or a short position. Okay, so write down SG has taken a short position. SG has taken a short position. The future seller gains. The future seller gains if the spot price on maturity is less than the future contract price. Is less than the future contract price. Is less than the future contract price. So my question to all of you is, what is the gain? He has sold at 2400. Market is 2100. 300 rupees is the gain per unit into 5 lots into 75. What is the answer? 1,12,500. Is it right? 1,12,500. 1,12,500. So that was the answer of this very good question from November 2020 RTP. Now we'll go to question number 2, which is November 19 exam question for 8 marks. 8 mark question, very important. Again write down, very important question, and this time I would like you also to answer. The NSE 50 index future are traded with rupee value being rupees 100 per index point. 1 point is equal to 100 rupees. On 15 September, the index closed at 1195 and the December future, which is the last trading day, December 15, were trading at 1225. So you tell me the number of days between 15 September to 15 December, because they have given you days calculation here. How many days are there between 15 September and 15 December? 91 days. Okay, we'll check later. The historical dividend yield on the index has been 3% per annum. This is dividend yield. And the borrowing rate was 9.5% per annum. This is the interest rate. Determine whether on September 15, the December future were underpriced or overpriced. The formula we will use is the same, because this also has dividend yield and interest rate, but this time the question is of arbitrage. whether the future is underpriced or overpriced. For that we will do our calculation and see whether it is equal to more than or less than the rate at which it is quoted. But suppose you find that it is undervalued or overvalued, then the next question will apply. Whether arbitrage transaction is possible to gain out of this mispricing. So you have to explain what arbitrage action will you take. Calculate the gain or loss. Then after you have taken arbitrage position, wait till 15 December. Wait till 15 December. That is the maturity date. When the index actually closes at option A or situation A 1260 and 1175. So in both situations, you have to demonstrate that the person is definitely going to get arbitrage profit. Okay. And in this question, use 365 days in a year for your calculation. When they are mentioning this line, it means the calculation this time will be in days, not months. And add one more line from my side. Do not use continuous compounding. Write down please. Everybody please write down. Do not use continuous compounding. Such questions are asked in the exam for 8 marks. So my first step would be to calculate the theoretical value of index future using the formula. So when they are saying do not use continuous compounding, I will just apply normal interest calculation. I will take the spot price and I will add the interest on that. Okay. And because dividend yield is also given, I will take interest minus dividend yield. Okay, like the previous problem. So I hope you are ready. Yes or no? Write down step 1. Calculation of equilibrium price. You can write equilibrium price. Calculation of equilibrium price means at this price there is no undervaluation or overvaluation. So this is my spot price and this is my interest and dividend yield adjustment. Okay. Solve. Take your calculator. First you solve this part, which will give you interest and dividend yield effect, plus 1195 plus 1195. Anybody who has got the answer can reply. Please reply if you can. Anybody who got the answer will reply. So the answer is, final answer is 121437. 121437. Is the answer right? Is the answer right? 121437. 121437. And what is the actual value of index future which is trading in the market? 1225 they have given. 1225. So it means it is overvalued. Step 2, write down. Step 2, write down the current market price of December 15 future is, the current market price of December 15 future is rupees 1,22,500. rupees 1,22,500. Why 1,22,500? In bracket write down 100 units into 1225. So it should be 121,437, but it is actually 122,500. So write down it is overpriced. It is overpriced. It is more than what it should be. It is overpriced. So the moment you find that future is overpriced, it will give rise to arbitrage opportunity. Step 3 write down. Step 3 arbitrage opportunity. Arbitrage opportunity write down. The investor should, this is overpriced, so you will sell future contract. The investor should sell future contract and buy the stock. The investor should sell future contract and buy the stock. Only selling future contract will not be enough, because in order to create arbitrage opportunity, you have to ensure that irrespective of whether the price goes up or goes down, you should be able to make the profit. If you only sell future and if the price goes up, you will lose. But if you buy stock also, the loss in future will be compensated by the gain in stock. Okay. So this was my answer is not over. Is arbitrage possible? The answer is yes. Now we will see how much will be my net gain because of this arbitrage. Under that write down cash flow on September 15. Today I have taken a position. I have sold future and I bought the stock. I have sold future and I bought the stock. So what will be my cash flow? In order to buy the stock, you will have to borrow money. In order to buy the stock, you need funds. So you will borrow money. So write down buy stock. Buy stock worth. What is the spot index? Spot index is 1195 into 100. One index unit is equal to 100 rupees. So today you will buy stock of 1,19,500. Which stock you will buy? Those stocks which are included in that index. Okay, the index stocks. And then how do you fund your stock? By borrowing. Borrow rupees 1,19,500. At what rate you will borrow? Given in the first line or maybe in the fourth line of the question, 9.5%. 91 days. This 91 days is the difference between 15 September and 15 December. Okay. So 119,500. Interest calculation in the next working note. Step number C write down. Sell future contract. Sell future contract at 1,225. There are people who are willing to buy future at 1,225. Market rate is 1,225. So sell. When you sell future, that day there is no cash flow. It is just a contract. Cash flow will come on maturity date in the form of gain or loss. Is it right? We are ignoring the initial margin money that is required to be paid, because question is not there about margin money, but otherwise you will have to pay some margin money in practical world. So what is my net cash flow today? Net cash flow today A plus B plus C. Yes, Mehul, what is net cash flow today? Rangaiya, what is net cash flow today? 0. Positive, negative, cancel out. But the important thing is, we have to ensure that we don't lose on 15 December when the index closes at 1260. We have taken a short position on index, but index has gone up. So are we going to make a net gain or net loss? Net loss or net gain we will see, because I have 3 positions. I have bought the share, value has gone up, on share I will gain. I have borrowed money, I have to pay interest, and I have taken a short position on index, I will suffer the loss. So I'll take the net total, and the net total should be positive. Correct? Right. Calculation of gain or loss on 15 December. Calculation of gain or loss on 15 December. Under that, write down case 1. Index closes at 1260. First case 1, index closes at 1260. I have borrowed money, I have to repay along with interest. I have purchased the share, I have to sell it. In the meantime, we will get dividend yield also. Dividend yield is also there. So we will get the dividend yield also. That will be my inflow. And I have taken a position on future. So I have to consider gain or loss on that also. So first point A. This is a very good question. Very few students are able to get it right. First point A, write down repayment of loan along with interest. Repayment of loan along with interest. Repayment of loan along with interest. So first you have borrowed 1,19,500. On that you compute interest at the rate 9.5% for 91 days. What is your final answer? Come on. 122,330.35. Very good. Point B, write down loss on future contract. Loss on future contract. Future contract, you have short sold at 1225, but actually the rate has gone up. So 1260 minus 1225. You will lose on future contract position. 3500. Very good. And you have purchased stocks. You have purchased 100 stock. So you will sell at 1260 rupees. Point C, sell stock at 1260. Yes, 100, because initially also you multiplied by 100. So that is 1,26,000. It will change proportionately, whatever may be the number. But for calculation purpose, we will take 100. Then dividend yield. Add dividend yield also. Dividend yield 1,19,500 into 3% into 91 by 365. 3% is the per annum yield. So we will take proportionately for 91 days. 893.79. Very good. Now my learned student will take the total of the last column. There are two negative, two positive figure. gain will be equal to 1063.44. So whether the market goes up or goes down will make gain. This is gone up. Now I will take a situation when market goes down. Very good question. Mark it important. Case 2, write down. Index closes at 1175. Index closes at 1175. Index closes at 1175. Right hand side rupees. First point A, repayment of loan. Only one line will change, the gain or loss on future. Okay. This you don't need to show the calculation again. Just write down the same figure again. No need to show the calculation again in the same problem. Save time. 122,330.35. Then you will gain on future. Why? Because now the Nifty index has gone down and you have taken a short position. So short seller will be happy if the index goes down. So the profit will be 1225 minus 1175 into 100. How much is that? 5000 gain. Sell the stock, but now the price is 1175. Sell the stock at 1175. Sell the stock at 1175. 1175 into 100. 1,17,500. And you write down received dividend. Same number, received dividend will be same. Received dividend 1,19,500 into 3% into 91 by 365. Huh? It will be same. Because there is an arbitrage opportunity. Okay. In first case it was 1260. Now it is 1175. Whatever happens, whether market goes up or goes down, this much arbitrage profit you are going to make. Arbitrage profit means without any risk, without any investment. You have not invested from your pocket. You have borrowed money, invested. You have not taken any risk also, because whether the market goes up or goes down, you are going to make the profit. That is called arbitrage profit. Now I am going to take some important question on options. Okay? Derivative. Second part is options. Question number 1, derivative option. Option is a right but not the obligation. There are two types of option: call option, put option. Call option is a right but not the obligation to buy. Put option is a right but not the obligation to sell. When you are buying a call option, you are expecting price will go up. When you are buying a put option, you are expecting price will go down. Is it right? So the holder of a call option will make profit when the price goes up. The holder of the put option will make profit when the price goes down. So on that ground, we'll solve a small question which will give you an idea about call and put option, how call and put option profits are calculated. So tell me students, are you ready? Say yes, we are ready. Yes sir. Student in the classroom is saying yes sir. So start. This question was asked in 2008 exam, and please mind it was asked in April 22 MTP also for 6 marks. So after so many years they have asked it. Again they will ask in your exam. This is a very easy question. Mr. X established the following spread on the Delta Corporation stock. What is the name of company? Delta Corporation. First he has purchased one 3-month call option. 3-month call option means expiry is after 3 months and the quantity is one only. Here one contract. And what is the premium he paid? 30 rupees. This you have to pay at the time of entering into the contract, and an exercise price of 550. That means if the market goes, if the share price is more than 550, the option will be exercised and you will get profit. If the share price is less than or equal to 550, option will lapse and the profit will be zero. That is the meaning of call option in this example. Second, purchased one 3-month put option with a premium of 5. Premium you have to pay at the beginning and exercise price of 450. In case of put option, if share price is less than 450, you will exercise the option. If share price is greater than or equal to 450, option will lapse and the value of the option will be 0. The basic thing you have understood. Now the question is, Delta Corporation stock is currently selling at 500. Today's price. Calculate profit or loss if the price of Delta Corporation remains at 500 after 3 months. Situation 1, the price remains 500. Situation 2, price goes down to 350. And third, the price goes up to 600 rupees. Assume the size of the option is 100 shares of Delta Corporation. One option has how many units? 100 shares. So your final answer multiply by 100. Your final answer will multiply by 100. One more line. Name the strategy adopted. Add this from my side. This I have added. This line I have added. Name the strategy adopted. So if you have studied this chapter, you can answer what is the strategy adopted. When you buy a call option and you buy a put option having same maturity date but different exercise price. Same maturity date but different exercise price. What do you call it? This is called strangle. Write down. This is a strangle strategy. When the exercise price is also same, it is called straddle. Okay. Straddle is when exercise price is also same. So I will just give you a small note. Nowadays they don't ask question on strategies. One student have asked me this query also, that they don't ask question on strategies. Why you are taking it? May 2022 MTP. Is it right? And it was in the RTP also, I have not mentioned actually. So if they are asking in RTP and MTP, they can ask in the exam also. And there is no harm in knowing one question. So I will give you a note first on strangle strategy. A strangle involves simultaneous purchase or sale. A strangle involves simultaneous purchase or sale of option simultaneous purchase or sale of option in bracket call or put with same expiry date but with different exercise price This is an example of long strangle. Okay, long strangle, write down. Why would somebody buy a call and buy a put at the same time? Because market view is mixed. Means market can go up also, go down also. Like after the election, results are announced. Market sometimes can go up or go down. If there is no clear majority of a party, markets go down. Similarly, after budget announcement also. So that means somebody wants to make profit from a rising market also and a falling market also. That is called market views mix. Second line, what action will you take? Action is buy put and buy a call at different strike price. Profit potential, write down unlimited. Why unlimited? Because you have bought a call option. If the price goes up, the call will generate more and more profit. So profit potential is very high. And what is the loss potential? Limited. How much maximum you would lose? The premium that you have paid. The maximum loss is the premium that you have paid. Is it right? So now we'll solve this question. Write down calculation of payoff of the option holder. Calculation of payoff of the option holder. Calculation of payoff of the option holder. Make a table with 3 columns on the right side. First, write down share price on expiry. Share price on expiry. Under that 3 columns, as per the question, 500 rupees, 350 rupees, 600 rupees. Understandable? Now write down point A, value of call option. Value of call option. In case of call option, we have a right but not the obligation to buy. So either my payoff will be positive or zero. Either my payoff will be positive, that is S minus E, or zero. It can't be negative. You are holder of an option, you paid a premium for that. And what is the exercise price of call option in this question? 550. So how do you compute? 500 minus 550 or 0, whichever is maximum. Minus 50 or 0, which is maximum. Minus 50 or 0, which is higher. 0 is always higher than negative number. Okay, same thing for second situation. 350 minus 550 means minus 200 or 0. Yes, otherwise forget the formula. If the share price is below the exercise price, write 0. What about the last column? Anybody for the last column? Anybody wants to reply? What will be the answer for last column? What will be value of call option? Anybody reply please? Is it 50 rupees? 50. Just write 50, will multiply by 100 afterwards. Value of put option, write down. Value of put option is maximum of E minus S or 0. Preeti is right, Mehul is right, very good. And what is the exercise price of put option? 450. So you will compare 450 with 500. If the market is more than 450, just write 0. If the market is less than 450, take the difference. Second column, everybody. Preeti, Mehul, other student, Rangaiya, 100 rupees, very good. Last column, anybody, last column, market price is more than exercise price, 0. Total, write down. Total 0, A plus B, A plus B, 100 and 50. Then write down point D, premium paid on call 30 rupees, on call 30 rupees, inner column, on put 5 rupees. So the total premium paid to create this strategy is 35. That you have to pay at the beginning. So that is the cost you have to incur to create this strategy. Point E, net payoff per option. Net payoff per option. Net payoff per option. So you will consider these two lines now. 0 and minus 35. Minus 35. 100 you will get, 35 you have paid. 65. 50 you will get, 35 you have paid. 15. This is per unit. Now write down last line. Last line, write down total payoff on 100 options. Total payoff on 100 options. Total payoff on 100 options is 100 into 35 minus 3500. 100 into 65, 6500. 100 into 15, 1500 positive. So in some exam only for this much effort you will get how much? 6 marks. 2 marks, 2 marks, 2 marks. So whatever strategy they give, you just write the prices, do the calculation by the knowledge of call and put minus premium, and that gives you the answer. Premium you have to deduct in all the columns. Very good. Any other query? No query? This answer is over.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website, Vinod.in. It is a perfect solution for your last minute revision.